There's been a lot of market-making news lately, and that has propelled options premiums higher. So we're going to talk a little bit about selling options premium today on Open Interest. Hello, everybody, and welcome. I'm Mike Coe. Welcome to Open Mic, where we talk investing options, and I take your questions. But before we do that, I thought today we might talk a little bit about coming up with systematic approaches when selling options premium and whether selling options premium is a good idea. Part of what got me thinking about this was I was taking a look at NVDA options after the AI rout that took place last week. And there's a number of other stocks in the same space, as you might expect, that similarly have extremely elevated options premium. So what I was doing was I was taking a look at something called the volatility percentile. What is the volatility percentile? The volatility percentile is simply a contextual measure of where options premiums are relative to their own history. And it's just a way that we can take a look at options premium and establish whether they are expensive relative to their own history or cheap. And one of the reasons that we like to do that is because volatility tends to be a mean reverting process. And the other thing is that oftentimes you get these knee-jerk reactions in the marketplace. Stocks will move sharply, options premiums will move sharply higher as well. And then that will, things will eventually start to settle down and they can come in. And I thought, just as a little bit of history, some of you might be watching me now because one of the more prominent options premium sellers is basically the reason there was a TV show about options trading on CNBC in the first place, Options Action. So Tom Sosnoff, some of you may know, some of you may not know, Tom Sosnoff was the founder of the options trading platform Thinkorswim. Thinkorswim was ultimately acquired by TD Ameritrade, and TD Ameritrade relatively recently was acquired by Charles Schwab. Tom has gone on to found a new entity called Tasty Trade, and he was really, I think he worked with some of the folks at CNBC, but the idea was he really wanted to educate investors and regularly give examples of trades that they could do that had high probability. And, more often than not, when I talk about options trading, I'm often looking at upcoming catalysts, such as earnings. I'm looking for stocks that I think are beaten up a little bit too badly or might be a little overbought. And I'm really looking at directional plays. But I haven't really been covering that much about systematic strategies that sell options. And that is something that I quite firmly believe in. So I thought we might do that a little bit today and just talk about some considerations, maybe see if we can't find a couple examples, and then move on after that to take some of your questions. So let's, now I have on my screen right now, well, let's even before, this is going to be a sea of numbers, I realize that, so I can probably blow this up a bit so we can see it a little bit more easily. Even this way, it's probably not going to be that easy. But I'm going to point some things out, and this is really just a spreadsheet that I'm going to use for screening purposes. But here are the things to think about when selling options premium. So in general, you're trying to capitalize on a couple dynamics with respect to options when you sell options rather than purchase them. Number one, you are trying to get the odds in your favor at least as much as the probability of profit is better than 50%. Generally speaking, debit strategies where you might buy a call spread or buy a put spread, buy a call, buy a put, something has to happen for that options trade to become profitable. Whereas if you are selling options, so if I sell an upside call, if I sell a downside put, three things can happen. The stock can go up, it can stay where it is, or it can go lower. And two of them are going to result in profits for the short options trader. So the idea here is that you're trying to increase your probability of profit. In order for a strategy like this to work, you need to manage your risk quite tightly, and you need to do it again and again. So what are some of the things that are kind of important when thinking about selling options as a regular strategy? How far out should you go? How far out of the money should you go? What are you looking for in terms of volatility? And what fundamental factors might you also be interested in considering before you start selling some premium? So I have shown in the past charts that show, for example, the term structure of volatility. And I'm going to bring that up right now so we can take a look. We'll look at NVIDIA's because that happens to be the one that I was taking a look at. And in general, so we're going to I'm going to go back. Let's go back a month. Let's take a look at that. Okay. So here we go. I think this is kind of informative. So what you're looking at right here, the red line, which I'm currently highlighting, that's where the implied volatility, the price of options on NVIDIA were for different expirations. In this case, I'm only going out about 6 months. I can adjust the view so that it can go further out in time, but I think that's just going to sort of cloud the issue for now. We're not really going to talk about selling really long-dated options. I don't recommend that in any case. So this was the price of options about a month ago, and this white line is the price of NVIDIA options now. So you can see that it's considerably higher. And if volatility is indeed a mean reverting process, is this an opportunity to sell some options? And if it is, which options should you be considering? So the first thing I want you to think about is this red line reflects, we'll call it a normal term structure of volatility. If you were looking at a futures curve, so near-dated futures to outdated futures, longer-dated futures, a shape of a term structure like this one, where the front end is lower than the back, futures traders would call that contango. But this is basically kind of a normal setup for volatility in most cases. You will very often see that longer-dated options premiums are higher in implied volatility terms than nearer-dated ones are. There is a specific exception to this, and that exception actually is reflected right here. So where this little hand is, that captures a specific event, which is the earnings that the company is going to be reporting on, I believe, February 26th. We can go to that in a sec. I don't want to flip around the screens too much, but just give you a sense of what is going on here. So in Tom's case, because some of you may be familiar with his work, I mean, he has a lot of stuff out there, and he's done a lot of, I think he's one of the true evangelists for retail options trading. And I should point out as well that his background, he too was an options market maker. If memory serves, he was a market maker on the CBOE. I was a market maker on the PHLX, the Amex, and the NYMEX. So equities, ETFs, indices, cash settled indices on the PHLX, and then commodities on the NYMEX on the option side. But the interesting thing about this is that I just want us to think about for a moment is that if a volatility term structure looks like the white line now, and we expect it to revert at some point in the future to the red line here, well, two things will happen for the option seller that are beneficial. Time will pass, options decay over the course of time as time passes, but the other is that the implied volatility for the options that you've sold are going to also come in. So the way I like to reflect this to people is that, and we'll take a look at a specific example right now. So I'm just going to construct a trade in NVIDIA. And I think I started to talk about this last week, and then I realized, you know what, this is probably something that deserves a little bit more time and attention. And then I'm going to start talking a little bit about how we screen for these kinds of things. And we'll walk through some sort of, not real-time data because the market's closed, but data from today. Okay. So The way Tom typically sets these up, and I know a lot of other people do this. Carter Worth, by the way, he also has a short strangle strategy. So for people who happen to subscribe to Worth Chart, I think if you subscribe to Worth Charting, he periodically says you've been strangled, and you get an email and it says, I think you ought to sell the following strangle. And what's interesting is that Carter and Tom, to the best of my knowledge, have never collaborated in any way. But interestingly, I happened to do some analysis for Carter on his short strangle strategy, and one of the things I noticed was that it happened to adhere relatively closely to the strategy that I've heard Tom espouse, with one notable exception, and that is that Carter will sell a strangle and then he will just ride it all the way to expiration. Tom does not advocate that, and we're going to get to that in just a second. But so basically, if you're selling a strangle, for those of you who are unfamiliar, you're selling an upside call and you are selling a downside put. Now, I want to make one quick point before you start clicking away and selling these things, and that is that if you sell an upside call, you are taking potentially unlimited risk, because a stock, in theory, can go to the moon, right? And if you are short the call, you're short at the strike, you're facing unlimited risk. You can imagine, for example, that had somebody done that in GameStop, you end up being net short the stock right before a roaring kitty basically helped initiate a short squeeze. You're taking a lot of risk in that situation. I'm going to talk a little bit about, if you're selling strangles, how you sort of identify stocks that you might want to avoid doing that in. But there's other strategies you can do. I don't want to cloud it right now, but you can do iron condors, where you sell an upside call spread and a downside put spread, or you could just do an upside short call spread and a short put on the downside, things like that. But one of the things that Tom does, and Carter too, as it happens, is they look to sell 20 delta calls and puts. Now, if you happen to be using options play, that's going to be the number that's over here on the right-hand side. So you can see this number 25, 24, 23, and so on. So the 20 delta call in NVIDIA that expires in 45 days, 46 days, 45 as of tomorrow, since that's going to be the first trading day. That's the 148 strike call. In this case, is the 20 delta call. And then 20 delta put is the 98s. Okay, so this would essentially be what your strategy would look like right here. So you would be selling a package of options that expires in a month and a half for $6.50. And there's a couple ways I like to think about the risk of this. One is over the current stock price, so $6.50 over, we'll call it $117. So that's 5.56% of the current stock price. And you are collecting that premium for taking the risk that you will either get long the stock at that downside put strike of 98. So that's 98 over, again, we'll just use 117 to keep the math easy. So that's down about 16% from the current stock price. Or that you would get short the stock at 148, which is up about 26.5% from the current stock price. But the real price at which you'd be net long, you would actually deduct the amount of premium you're collecting, or $6.50 a share. So your actual purchase price would be about 91.5 if you were getting long at that level, and your actual sale price would be well over 150. You're looking at 154.5-ish if you were to get short at that level. Now, this is kind of important when you think about it, because that essentially, that's an all-time high. Is the stock going to hit an all-time high between now and March? Well, they have earnings coming up on February 26th. They could potentially blow the doors off, but that would be quite a remarkable move, right? So, in fact, why don't we just quickly figure out, so that you would actually only start losing money if the stock was up more than 32%. So in other words, if you sold one of these strangles and you decided to ride it all the way to March expiration, I'm not suggesting that, but let's just say that you did. if the stock went up 50% over the next month and a half, then you would be losing about 18% on a 100 lot. Okay? So if that makes any sense at all. And of course, the stock would need to fall quite precipitously as well. So let's talk very quickly about delta. It turns out that the way the math works, delta really represents two things from an options trader's point of view. The first thing that it represents is the hedge ratio, or the rate of change in the value of the option relative to changes in the price of the underlying stock. So you can think about this as a number from 0 to 100%, or 0 to 1, however you choose for a call, or from -1 to 0 for a put. But in terms of probabilities, we can also think of the delta, the absolute value of the delta, as the probability that an option will expire in the money. So another way to say that is that the options market is implying that there is a 20% probability that the 148 call expires in the money. There's a 20% probability that the 98 put expires in the money. Of course, it can't do both at once. The stock, as of expiration, can either be higher, or it can be lower, or it can be somewhere in between. What this also then tells us is that if there's a 20% chance it's above 148, which is where we would start to see our profits drift off, and a 20% chance that it's below 98, again, where our profits would start to drift off, that means there's a 60% chance that the stock actually lands in the middle. And that is the probability of max profit. So if you're looking at this diagram, the highest points in here, so the $650 you would get for selling this, that is between those two strikes. And you can see here that if you're looking at options play, it calculates a 70% probability of profit. So that's not a probability of max profit. That's just a probability of any profit, even a penny. So we know that the downside break-even is 91.5 and the upside break-even is 154.5. So 70% is the probability that the stock falls inside of those break-even ranges. So let's also talk a little bit about whether $6.50 on a $117 stock over 45 days is a reasonable rate of return. So I can say $6.50 over $117 is about 5.5%, and I'm going to divide that number by the 45 days to expiration. Then I'm going to multiply that by the number of days in a year. So that works out to 45% annualized. That's the rate of return that you would be getting for selling that strangle. 45% annualized. And the question we want to ask ourselves also is that a good number? Is it a bad number? And so Steve Garcia is saying naked strangles do require significant collateral unless one is on a margin account. I'm going to assume that many of you are at the very least on Reg T margin accounts, and probably several of you are on CPM, customer portfolio margin accounts, which is a set of margining rules that is actually very similar to what we had when we were running on what's called a JBO, which is a joint back office. So, for example, in the late 90s, when I first got into the business, we cleared at a firm called Spear, Leeds & Kellogg. Spear, Leeds & Kellogg was acquired by Goldman Sachs. So essentially, we were a customer of Goldman Sachs, and we got to use their balance sheet. And they had the ability to cross-margin not just everything that we were trading as a firm, and we had a number of traders, and we had a number of positions, probably traded 250 different underliers, and I don't even remember how many traders we had. We probably have 50 employees or something like that. But the JBO rules and customer portfolio margin rules are similar in many respects, and it's really a risk-based margin. So, once you feel ready, if you don't have customer portfolio margin at the moment, it's something that's probably well worth looking into. But if you don't have it, that doesn't mean that you can't sell premium. It just means that you might have to do some things to bring those margin requirements in. What are some of those things? Well, you could convert this into a condor, as I was just describing. And the way you would do that is you would add a long call, you would add a long put that is out, each of which are outside of the strikes involved here. So, for example, on the put side, maybe I would choose the 88 puts, and on the call side, maybe I would choose, so that was $10, so why don't I go out to $10? We'll look at it like that, like this. Did I do that correctly? Call put. I'm buying the 88 puts. That structure does not look quite right. What did I? Oh, whoops, sorry, 138. It's supposed to be 158. Knew that picture looked wrong. There we go. Okay. So this would have significantly lower margin requirements than just a naked strangle would. Now, whether or not you're comfortable, say, selling a naked put, naked meaning unhedged, uncovered in some way, or a naked call, depends a little bit on whether you are willing to simply get long the underlying stock or willing to get short the underlying stock. If you would say, I am willing to get long NVIDIA around $90, and I am willing to get short NVIDIA up around $150, and you would actually do those trades, then selling the strangle essentially is subjecting you to the risk of doing both of those things, and you should be comfortable with that amount of risk, assuming you have the capital available to do it. But the important thing to think about now is, okay, is that 45% a year annualized return sounds spectacular? You know, who doesn't want to get 45% a year? That's an excellent rate of return. A lot of hedge funds would be very happy to deliver returns like that. Is it a good rate of return though? Well, actually it depends a little bit. So what does it depend on? And it really depends on two things. So the two things that it depends on are how volatile is the stock? Because if the stock is extremely volatile, well, the chances that you're going to lose your money are much greater. So you need to, of course, get a greater return to get there. So I'm also, by the way, I'm just going to put these break-evens, I'm just going to scroll out here to March, okay? And we're going to put some annotations in so that we have a sense of where your break points are in this trade. So I'll just draw some arrows. So we're right about here right now. So your upside break even by March expiration. And I was selling the 148 call. So this is, I'm just going to put the, it's going to be approximate. It's going to be up in here. And the downside put that we were talking about was the 98s. Oops. So that's going to be down here. So that's your break points, essentially. So you're making a bet. You're getting 45% annualized to bet that NVIDIA is going to lie somewhere within that range by March expiration. And part of whether or not that's reasonable is going to be based on how the stock behaves. Now, as we can see, this stock's been reasonably range-bound. I mean, obviously, it's had some big jumps lately. But I'm just going to put those breakpoints in here so we can sort of see how that shapes up in a historical context. Now, another way to measure this, of course, is by taking a look at what we call realized volatility. That's the standard deviation in an annualized sense of how much the stock is moving around. That's the range that the stock's basically right in the middle of this range right now. It has been right in the middle of this range since May of last year. So the question is, does that seem reasonable? Well, looking at the chart at least, that seems reasonable. Let's look at it in implied volatility terms. So how much is this stock actually moving around, and how much does it typically move around? That's an important consideration as well. So what we're looking at now is the realized volatility over the last 2 years for NVIDIA. So all this is, realized volatility is the standard deviation, but it's always expressed, when options traders talk about the volatility, it's always expressed in an annualized term, even if you're only looking out 30 days or 60 days. So they'll say 30-day vol. In this case, we're looking at 30-day vol. They'll say, well, 30-day vol is 70 or it's 40. But the truth is that what they're really saying is that the annualized standard deviation is 70% or 40%, something like that. Now, if you want to standardize that, so you said, okay, well, what's the standard deviation over 45 days then? You know, I mean, I'm looking at a 45-day expiration. How do I translate that annualized number into something that is actually going out to the expiration of my options? So the first thing I would say is, I'm just looking over here. I don't know whether you guys can see this or not, but the mean volatility over the course of the last year was 48.6. Let's round it up and call it 50. Nice round number. And one of the other things you're going to observe is that the way it behaves, actually, it's very low, and then it has these big high periods, and then it's very low, and then it's very high. So why is that? Well, one of the reasons that happens is because there are things that cause a stock to move sharply that aren't occurring every single day. What are examples? Earnings, obviously, is one of those examples. What's another example? DeepSeek coming out and saying, hey, we just came up with a large language model that is as good or better than ChatGPT, which depends heavily on NVIDIA chips, but we didn't need to use so many. Now, that's a little dubious, that suggestion. So I'm not completely buying that, I have to say. But that's what's going to cause these unusual situations. Okay, so you have that annualized volatility. Now you want to translate it to 45 days. What do you do? Well, we're going to just take 50 vol. So that's the annualized number. And we have options that expire in 45 days. So how many days are in a year? We're going to use calendar days. If you were looking trading days in advance, then you would be using trading days for your sort of period. So the options expire in 45 calendar days. So there's 365 days in a year. I divide that number by the number of days that I'm trying to look at, which in this case is 45. So that's 8.1. And then I take the square root of that number, which is 2.84, and I divide 50. I then divide my volatility by that square root, 2.85. Okay? So you divide by the square, what we call the square root of time. So that means that the standard deviation is about 17.55%, 17.5%. Now, this should make some sense as we go back to those, those breakpoints. Why should this make sense? Because remember what I said initially. I was saying that there was about a 60% probability that the stock was going to be inside of those two strikes. I have to draw them again, unfortunately. I apologize. This is, a little bit on the slow side, but so between here and here, the strikes that you're short, a 60% chance, one standard deviation, 68% of anticipated outcomes lie within one standard deviation. So these moves were less than 17%. 17.5% is one standard deviation, and that's, getting pretty close to where the break-evens are. So one standard deviation. So about 70% of the time, this trade should be profitable. And the risk that you're taking, of course, is that you get short at that higher strike or long at the lower one. And what you have to contemplate when you're deciding whether it's a good idea or not are a couple of things. One is this volatility, the ranges. So that's just taking a look at the stock prices. And then finally, what I was just referring to before, and something that Tom talks a lot about, and your systems probably have this, but what I'm talking about now is the volatility percentile. So what is the vol percentile? Let's see if for NVIDIA. Now, I already happen to know what it is because this is what got this whole conversation started in the first place. And that is that it's over 90 right now. So we're at a 96.8. That's where we're at right now for NVIDIA. So if you take a look over the course, and by the way, just so you know, the way this is defaulting is it's looking at 90-day or 3-month implied volatility, and it's looking at a 2-year history. So what that means is that if you looked at 3-month options premiums over the last 2 years, there were only 3% of those instances where 3-month volatility was higher than it is right now. So options premiums are at the upper end of that range, if that makes sense. And that's one of the things that I know Tom tends to focus a lot on. And, I'm only bringing up Tom because he happens to be one of the people who really has made an effort to sort of educate traders on things to think about in a systematic way. So what are other things that I like to think about before you start contemplating whether you're going to sell options premiums? And so I'm just going to go over a couple of those really quickly, and then I'm going to start taking some of your questions. So a couple things that I worry about. Short interest. If the thing has a really big short interest, you are at risk potentially of a short squeeze. So let's take a look. What's the, here's a stock that's 13% short interest. What are we looking at? International paper. So you're going to want to look at the short interest. If the short interest is, we'll call it greater than 10%. Now, sometimes the short interest can be, so we're just going to take a look. So here are some stocks that have a lot of options activity, but the short interest is very high. So we're looking now at, United States Steel, of course, that's a deal stock, right? So that's the other thing. You still have to pay attention to other types of fundamentals. Corporate actions being a good notable example. It's a company that was in play, right? So Nippon Steel, they had a potential deal there. So that's an example. MicroStrategy, obviously a very volatile and risky situation. Rivian, this is another one. SoFi, Carvana, very heavily levered business, which brings up another issue, which is how much leverage is in the business. How much debt are they carrying? So I have that here. I'm just using a quick and dirty mechanism to calculate net debt. I'm just deducting the current market capitalization from the current enterprise value. So if that's a positive number, that's net debt. If it's a negative number, it's net cash. So Lyft, for example, has more cash than debt. Okay, so that's something else to think about. The volatility percentile. Now, most of the systems, I believe, these days have that. So over here, you can see some of these are not all that exceptionally great. So I might be trying to look for circumstances where the volatility percentile is at least above 50. So, above average, if you will, would be helpful. And actually, percentile isn't necessarily, it's not the same thing as an average, but you get my point. So that is definitely something to keep an eye on. What's another thing I like to keep an eye on? Right here. This company, CCC+, this is not investment grade, right? So if you are selling, when you sell options on an equity, you're actually taking risk kind of the way a creditor would. So I get very concerned about circumstances where, now some of these don't, they don't actually have a formal credit rating. But if something is not investment grade, that's usually on my do not fly list. And you can see that we've got a couple. So if you don't happen to know right offhand, the lowest investment grade is BBB-, right? So that's you would exclude B, B-, BB-, and you would exclude, of course, CCC+. So those are all out. So, and by the way, these would all be excluded because of the short interest. So I'm actually going to put this in the other way and say less than 10%. And I'm going to say I want a volatility percentile that is above 50. Well, let's make it above 75. Okay. The other thing that you might want to do is keep your eye on potential market moving catalysts like earnings. So for example, anything that expires inside of, if you're trying to sell a 45-day option, one of the things you might say to yourself is, okay, well, that's implied volatility is at least going to stay static probably, or maybe even rise until that event takes place. So maybe I want to lose anything that's within that 45-day time frame. So that's going to eliminate all of these stocks here. So I'm just going to get rid of all intervening expirations where I'm selling options that, and that's going to get rid of NVIDIA, by the way. Although in part, I think NVIDIA is maybe worth taking a look at anyway, because I sort of feel like this DeepSeek thing is as much a catalyst as the earnings will be. So that leaves us with these stocks, things to think about, right? So we've got Dow, Lyondell, Marvell, Micron, DocuSign, GE Vernova. This is not surprising because GE Vernova was part of that AI trade as well, along with Vistra and several other types of names like that. Also, names like Constellation Brands, right? So anything, or Ultra, anything that's in the, well, Booz Allen Hamilton is not actually in the booze business, but booze business companies are among those that have seen a big uptick in volatility because they would be affected by these tariffs that are being discussed. You know, I heard Trudeau saying, or somebody in Canada was saying, okay, there's no more U.S. bourbon on Canadian liquor store shelves, you know, after this. One little side note on that, which I think is kind of interesting, is that they announced a 25% tariff. The motivation for that tariff was supposed to be the border, and the Mexican president said, we're going to work with you on the border, and we're sending 10,000 of our National Guard to the border to help with illegal immigration and with fentanyl. That was one of the things that they were specifically talking about, is fentanyl coming across the border. And Trump said, okay, we'll see how this goes then, and we're going to delay any tariffs and, you know, engage in the conversation. Meanwhile, Trudeau spent a lot of his time saying, you know, quoting JFK and things like that. I thought that was kind of a remarkable sort of distinction between how the two responded, because you know, it's kind of hard to know, is this a negotiating tactic? I mean, I believe this is in part a negotiating tactic. Is it to try to raise revenue, or is it actually to try to get some action on the border? Some combination of both. The reason I bring that up is because it seems to me that Trudeau could have done essentially what Mexico did and said, we're going to help out. If you're claiming that this is because you want better border security, we'll do our part. And I'm assuming that the administration would say, okay, then we're not going to impose tariffs right now. You know, no promises about the future, but we're not going to do it right now. So I just thought that was an interesting response. And perhaps by now Trudeau has responded after having seen that they delayed it on the Mexico side. And by the way, that also is part of the, you know, it's kind of interesting to me because I would have expected the market to be down a lot on this news. And, you know, it's down, we closed down less than 1%. And I think the reason for that is, you know, folks said, oh, okay, well, he threatened, they responded, he delayed. All of that happened very, very quickly. You know, maybe they're going to get a decent response. Who knows? But I just thought that was kind of interesting. Looks like Trudeau just made a statement. Oh, really? Oh, that's good. Well, yeah. Tariffs on Canada also paused for a month. Good. So I guess he learned his lesson. Harley Bob missed who Tom is. Tom Sosnoff. So Tom Sosnoff was the founder of Thinkorswim and Tasty Trade. So he is one of, you know, there's only a handful of people who have started $2 billion plus retail brokerage firms in, you know, certainly since in my professional life. And he built one from scratch, Thinkorswim, and sold it. He was out of the business and was basically just an options educator for a while. And then he started a new one, Tasty Works, Tasty Trade. And then I don't think they've sold that, but I believe they got a big investment, and it's also now a multi-billion-dollar business. So one of the greats, I would say, for retail self-directed trading, for what it's worth. So here are some of the other names that are on this list. Constellation Brands, if they're delaying the tariffs on Canada, I'm guessing this implied volatility that looks as juicy. What percentile was it in? It's got to be right up there. I'm guessing the 100th? Yeah, look at that. 100th percentile. Constellation Brands implied volatility as high as it has been in 2 years. So it's probably not going to get completely crushed tomorrow, but this is my point. These are the kinds of things you want to be on the lookout for, because you sort of need to look at these in real time and say to yourself, wait a minute, is this going to get resolved? Are we going to get a solution to this? And when it does, won't volatility come in? This is really what you want to be looking at. Also, if you're selling downside puts in a stock that's hard hit that you would otherwise like to own because you think the concerns are overdone, this is perfect, right? Everybody who was complaining when NVIDIA was trading $150 or almost, now you have an opportunity to get into a trade like this where potentially you would buy it down at 90 or sell it up at $150 and change. And that's I think, pretty compelling. So one of the things that, and I keep bringing Tom up because chances are they've done so many videos. I think they're basically making videos all day long. One of the things he has also said, which I don't happen to agree with, was that he said if you're trying to figure out how much you should expect to make from a strategy like this one, he said, as a minimum, triple the risk-free rate. So if the risk-free rate right now is about 5%, then he's saying you should not engage in this strategy with an expectation of making any less than 15% per year. So why do I differ with him on this? For one thing, risk-free rates have gone to 0. And 3 times 0 is still 0. That's part of the problem. But it's only one part. The other part is that when rates get very artificially low, that tends to coincide with risk assets being very high from a historical valuation perspective. If you are looking at bonds, they call this duration, which is the sensitivity of a bond's price to changes in interest rates. If you're looking at a 10-year bond and the rate of interest on that 10-year bond is 4% and rates change 1%, that bond will change a lot in value. On the other hand, if you're looking at a 10-year bond and the prevailing interest rate is 10% and it changes and the interest rates change 1%, it won't change as much in value. And we refer to this, so the relationship is monotonic, meaning that as interest rates rise, all else equal, the value of a bond or a fixing instrument goes down, but the rate of change is not consistent. That's convexity, right? So there is more, the rate of change in a fixed income instrument's value is greater when interest rates are very low. And when interest rates were very low, we also saw that the earnings multiple on equities was also very high. So we're going to look at this really quickly here because I know you guys are coming up with some questions, but if we look only at the history, and I'm going to go back now, we'll call it 10 years, okay? So this is where interest rates were extremely low, right? So we were in a heavy period of QE, interest rates were effectively 0, and the earnings multiple, and actually that was trailing, and of course we had the pandemic in there, so that's probably not the best way to look at it. Here's a look at forward multiples. It was very high. And if this doesn't make much intuitive sense, here's another way to think about it. So I usually like to try to describe things a couple different ways, and then hopefully one of them will resonate. The price to earnings ratio, if you invert it, is another way to think about the corporate earnings yield. If an asset is trading 25 times earnings, then that asset is earning 4%, right? So 1 divided by 25 is 4%. And if you had that's just a simple way to think about it. So And there's always going to be some relationship between the earnings that you get on a risk asset and other risk assets. So if bond yields go down, then it would also make sense that all else equal, corporate earnings yields on equities would also go down. So the reason I don't like Tom Sosnoff's 3 times the risk-free rate is that if risk-free rate gets into an abnormally low condition, I think you're actually getting paid very little for a lot of risk. And I don't like that. So the way I like to think about it instead is to say you are taking an equity-like risk because you are getting, if you say sold strangles, you are willing to get short the stock and you're willing to get long the stock. So that's an equity-like risk. Then you want to get an equity-like rate of return. Over the long term, the S&P has probably returned, and I'm talking about the last 100 years, maybe 12% a year. Over the last several, obviously, it's been much higher than that. But to me, those are the types of numbers that you're looking for. You want to get 12% a year or better. And of course, it will depend. If you are selling strangles on something like Kroger, the grocery store, well, this isn't a hugely volatile stock, right? Kind of a steady eddy. This thing has been between 50 and 63 basically for the better part of a year now. That's sort of been its range. If you're looking at Procter & Gamble, probably another example. Staple stocks tend not to move around a huge amount. So it's been between 160 and 180, and it's now trading 170. So that's a pretty tight range for most of the past year. So the rate of return that you would expect to get in something like that would be lower, but you would be looking to get a rate of return that's similar to the risk associated with owning the stock. So maybe 12% would be reasonable. To me, I think 12% is kind of the base case that you're looking for in terms of how much you expect to make in a short premium strategy. Okay. So, FinWest, good morning, Mike. Tariffs on, tariffs off makes for some volatility. Yes, indeed, it sure does. Yeah, and we are seeing that. But I also think it's interesting just how quickly we're getting affirmative responses from our neighbors, and he says, I'm going to make things happen really quickly, and then declares an emergency, because that's what's necessary, by the way. You can't just willy-nilly start putting tariffs on every country. It's because the fentanyl crisis, the opioid crisis, is considered a national emergency, and that the immigration issue is considered a national emergency, that gives additional latitude to the executive to do things like this. So, another one. I love how countries' tariffs announcements against us are targeted directly against Tesla. So childish. Yeah, I guess they're figuring, if we squeeze Elon, then he'll go running over to the West Wing from the old executive office building. I guess now look at the Eisenhower office building and say, hey, cut it out. I wouldn't hold out too much hope of that, particularly when one considers that Tesla isn't exactly valued like an auto company right now. It's absolutely valued on other technology. So imposing those tariffs, who knows? But yeah. Okay. Steve Garcia also says, I opened a February OIH 310-290 collar against my OIH shares a few weeks ago. OIH peaked over a year ago and has a bearish chart. Should I monetize the collar or simply close the entire trade? Well, let's just take a look here. Let's see here. So I actually said, I'm trying to remember when it was, and I used to, by the way, I started off trading the oil service index. So back in the day, in the late 90s, the oil service index this is before ETFs really took off. The Philadelphia Stock Exchange was very well known for 2 sets of options products that were kind of unique to that exchange. One was currency options, which were really big actually before I got down there. And that ended up going what we called upstairs. So back in the day, you had trading that took place on the open outcry floors, and then there was some over-the-counter trading that took place, on the phones with the banks. That became a an upstairs business. Now, there is no really upstairs. There's no downstairs. So there's no real floor trading. The New York Stock Exchange has a floor, but it's mostly optics. Almost all of the New York Stock Exchange volumes trade electronically. And the Chicago exchanges, to the extent that they've maintained floors, it's mostly because it just looks cool. You know, you can get it on CNBC or Bloomberg or whatever. But most of that trading is also all electronic now. I did feel that the oil services space was a little overdone to the downside, in part because, first of all, in many cases, these companies were about as cheap as they have been in quite a while. Some people thought there would be a great oil trade with the incoming Trump administration and their, drill baby drill rhetoric. The issue that I had with that was that the United States is already at peak production. And when I say peak production, I don't mean that we can't produce more. What I'm saying is as high as it has ever been, 22 million barrels a day equivalent, of which about 13 million is actually oil. So we're the largest energy producer in the world, well ahead of Saudi Arabia. And the problem that you have is that what is going to really encourage more use of oil services is going to be a demand from, for example, the E&P companies. And that really depends a little bit on oil prices, right? So you always have these sort of, opposing forces, if you will. Production increases, supply increases, prices fall, demand falls on the production side, that is, for things like oil service, because you don't want to pay $600,000 a day for an offshore rig. You don't want to pay, $10,000, $12,000, $14,000 a day for a tilt-up rig, that kind of thing. So, these companies are going to be impacted by both of those forces. Now, what is interesting, I read and have heard that one of the reasons that Trump wanted to rename the Gulf of Mexico the Gulf of America was because prohibitions that the Biden administration tried to put on drilling in certain areas was done by name, I think, rather than, I'd heard this, I have no idea whether this actually holds up at all. It would be kind of a really funny thing if it did. But, if they said, okay, well, you can't drill in the Gulf of Mexico and you rename it the Gulf of America, does that mean you can drill there? I don't know. But if that was what that was about, it's very Trumpian, I guess. Sorry, what was... Oh, yeah. So with respect to the question, my apologies. So OIH... And you said this was Feb? Oh, so this is coming right up, actually. And it's the 290. So here's the thing. You are basically in a 290, 310 call spread right now. Let's take a look at what that looks like. So for everybody else, edification. Obviously the technical trend for OIH is not that good right now. And as I said, I think that the drivers, are more fundamental than they are political. Oh, this is just clipping right along here. Okay. All right. Someone just drove by on the road to my right and they need a new muffler. Okay, so, we can see here that the sentiment's a little bit bearish, but if you're just going out here, we're just going to look. This is effectively the trade you have right now. And is it regular way February? Oh, you didn't specify. Let's just assume it is. So you're essentially, in a 290, 310 call spread. Synthetically, that's what that works out to. And the probability of profit on that trade is not that great, according to this. We did get a couple dollar pop in oil this feels a little light to me, I have to say, in terms of the probability of profit. But we can say this for sure, and that is that it's not positive, right? Because it needs to move up, and it needs to move up fairly sharply just to break even on your trade. So chances are you're better off closing it early. So, it's never nice to try to nurse a losing trade, but sometimes it's better to just close it and move on rather than holding on and hoping. Deploy your capital elsewhere. I guess that's the way I would put it. Okay, so Kirk, Amazon reporting after the close on Thursday. I ran the expected move on Friday's closing price, but I'm not comfortable calculating the implied volatility. Okay, so Kirk, I don't know whether your system, whatever it is, gives you that. This is an interesting trick, folks. So you can calculate the implied volatility by just knowing a couple mathematical tricks and knowing the price of the options and nothing else. So we're going to go through that math together here now. Let's first of all, let me just see we're going to see what Bloomberg says the implied move is, and then we're going to compare that to so they say that the one-day implied is 6%, and they report the day after tomorrow. Oh, today's the 3rd, so okay, so yeah, they're reporting on Thursday. Okay, fine. So we're going to take a look at the straddle, and actually this is related to what I was just talking about before with annualizing volatility. Okay, so stocks trading 237.5 on the number. Perfect. We've got it almost on the number. We have a 237.5 strike. That straddle, which is the 237.5 put and the 237.5 call, are $8 each, $16. Okay, so $16 over 237.5 is 6.74%. All right, so remember that number, 6.74%. Also remember, and I've talked about this before, but the mean absolute deviation is what some people will refer to as the average move. That is what the straddle is. So the straddle is the mean absolute deviation, or the average expected move, something like that. The standard deviation is that number divided by the square root of 2 over pi, which I'm going to round to 0.8. So that means that the standard deviation for the end of this week is 8.4%. Okay? So remember that number. 8.4% is the standard deviation between now and the close of business on Friday. But what did I say before? Options traders annualize standard deviation so that you're always talking in a common term. So how do we do that calculation? Well, 365, number of days in a year. 4 days to expiration. Square root of that. 9.55 times 8.4 is 80. Round numbers. 80%. Now, actually, in this particular case, let's see. Is it 4 days? Yeah. Or 5. Actually, I guess this was as of today, so it was really 5. So, enter. So 8.4 really. So that's more like, yeah, it's more like 71 and change. 70% vol, give or take. And, which number you're going to use is going to depend on whether you're talking about the bid or the ask, the middle. But that gives you some sense of the scale, right? And there was also that rounding error, right? Because I used 0.8 instead of, the actual square root of 2 over pi, which is 0.79 something. But that's the way you do that math. So if you don't have access to the implied volatility, you can calculate it if somebody, if you happen to know the price of the straddle. It's a neat party trick, I guess. You're hanging out with your friends and somebody says, oh, I'm looking at a $100 stock and a 3-month straddle costs $10. What's the implied vol? Now you'll know how to figure it out. They will be awed and impressed. Okay, So let's see here. What else have we got? I use Schwab. So Steve Garcia says, yeah, I use Schwab and I don't think it has portfolio margin. They just do normal margin accounts. So I have to set aside about 15% of notional. 15% of notional. So if you have to set aside 15% of notional on an equity purchase, that is customer portfolio margin because Reg T is 50. So you may have CPM actually. I don't happen to know. I've never discussed this with Schwab. But the other reason I say that is because I'm quite sure that Thinkorswim and then TD Ameritrade had customer portfolio margin. And it seems unlikely. They would presumably lose a lot of business after they acquired TD Ameritrade if they didn't continue to offer it. So I'm expecting that they do. And if you have to put up 15% on an equity purchase, that is customer portfolio margin because Reg T by law is 50, and then you re-up it at 25% decline, that kind of thing. So, okay. Great topic, Monday morning quarterback. What is the relationship between implied volatility percentile versus IB rank? They're basically the same. I'm assuming they use a similar methodology, but all you're really trying to establish is where is implied volatility in historical terms. And interestingly, when I'm looking at volatility percentile, when I was just looking at it before, I was looking at it for over a 2-year window, 3-month implied. Now, why would I use 3-month implied? When we were thinking about vol when I was a market maker, that was what I would sometimes refer to as my anchor volatility, which is that it's kind of how I thought about volatility in the name generally. And then I had other parameters to think about what the volatility of everything else should be. How steep was the term structure? How steep was the skew? How much puts are trading over calls? How curved is the kurtosis? How much were the wings bid up? That kind of thing. And so basically if I had a kurtosis number and a skew number, I had some slope for the term structure, and I also knew event vol, which is how much the thing typically moves on earnings. Then I could pretty much price every option on the board knowing just those things. I mean, I say just as if it's a trivial thing. It's not that trivial, but you get my drift. So with respect to the percentiles, let's just take a quick peek over here. So this is 2 years worth of 3-month implied volatility for Amazon. This is the 67.67 percentile, which means that it's higher than 67% of the time. And actually, you can sort of see that visually here. I'll just draw a line. So most of the time it was lower. However, you can see that when it was higher, it could have been substantially higher. Right? So that is also something to think about, which is if you get a trade right, it's helpful if it wins most of the time, but that's not sufficient. Because if, I win $1 2/3 of the time, but I lose $3, 1/3 of the time, that's not great trading. Right? That's not what we want. It would be much better if you make $1 or lose $1 and you win 2/3 of the time and you lose 1/3 of the time. That works. That math works, but it does not work if you have these huge blowouts. And that's one of the things about getting short volatility is that things can move quite sharply. And that's one of the reasons you have to do it again and again and again. And try to do it when the setup is good. So what I mean by the setup is good is that you would not want to do that when the volatility percentile was, say, below 50, so where this red line is. Selling volatility down in this neighborhood below this red line, if you can see that. I'm trying to look and see if you can. Yeah, okay. Statistically, that's not as good a trade. So if you have an opportunity to sell volatility when it's very high, that's probably going to work out better over the course of time. So short call, long put, Steve. So the OIH trade, that was your trade. I was just reflecting it synthetically. So long stock, long put, short call is a collared stock position. That's synthetically equivalent to a long call spread. And I'll illustrate that. I probably should have done this side by side so everybody can just be reminded that that's the case. But if anybody says that's not the same thing, it is the same thing, because long put, long call is long put, long stock is synthetically a long call. And if I'm then short another call, then that's a call spread. So to illustrate this, we are going to build exactly that strategy. So in here, we are going to be long a put, we're going to be long the stock, and we're going to be short a call. And I'll just, you were in the 310, I think it was the 290, and it was Feb. I'll just do Feb regs. Okay, so this trade is collared stock. And in here, I'm now just going to put in the same expiration call spread. And you're going to see that these trades are remarkably similar. Long the 290 call and short the 310 call. And oops, that should be a call. And you can see that synthetically these two things look very, very similar. See? And the only difference is going to be a minor cost of carry issue. So for example, the math is that if you were in the call spread, you would have a small amount of extrinsic premium that you laid out and no other capital commitment. So if you supported that with a certain amount of cash, that would be tying up less money than going out and purchasing the stock and then buying the downside put and selling the upside call. So one of them is going to be less expensive than the other because you have to make up for the interest that you would receive on the cash balance on the call spread, or else there would be an arbitrage. You know, especially, and maybe not an easy arbitrage to affect if you're a retail trader, but for the institutions it would be very easy. I mean, if those things didn't reflect the interest rate, then they would just buy the call spread and trade the other side and basically collect the interest for free. So it will typically reflect that. The expected move was 5.7% of the stock price. That's not what I saw. Let me just double check that. 5.7, that sounds low. I thought we had a number that was higher than that, didn't we? Wasn't the straddle for Amazon something like, I thought we came up with $16. That's closer to 7%, right? Not 5 points. So 6.75 versus 5. Well, the price could have been different when you were looking at it earlier today. I thought about doing a risk reversal, sell the 225 put, buy to open the 251 call. Yeah, I mean that's fine. I might favor. So here's the thing, right? What we want to look at is, well, how much does this thing typically move on earnings? What's the average move? If the average move is greater than the 6.75% that it's implying, then a risk reversal is fine, or buying a call or selling put, something like that. But if it's actually less, so if we don't normally expect it to move that much, then it might make more sense to do something like a call spread risk reversal, because you're going to get more immediate participation. So let's just put that together really quickly. So this is the weekly, and you could get long that at the money call, selling out of the money call. We just said that the average move is about 6%. So that is right around to the call that you were thinking about buying. So I guess it depends a little bit. If you happen to believe, if your belief is that it could potentially break out, and you're only interested in trading more than an average move to the upside, then that would, I guess, potentially make some sense. But if your thinking is that it's going to move something akin to what it has done historically, then you're probably better off doing, something like this. So that, this is just towards the end of the week, right? So you basically get the upside participation. If it moves the amount that it has on average over the course of the last 8 to 12 reported quarters, and that's the move you get to the upside, then you'll make money. And if it goes to the downside, you won't lose that much. So whether or not the risk reversal you're thinking of or the one I just illustrated is better depends a little bit on your thesis. You're making a bet by buying that 252.5 call. You're betting that it's going to move. Not only are you betting that it's going to go higher, but you're betting that it's going to go higher by an amount greater than the average move has been historically. If so, that's just something to think about. Okay, let me see here. Hour and 10 minutes. Let me see if there was something else in here that I think we covered most of it. So let me just wrap some of this stuff up, because I think this is, in the teach a man to fish category, right? What are you looking for? You want to have, if you're going to get into option selling, you want to have probability of profit that is better than 60%. So that would mean that you are going to be, if you're selling strangles, selling 20 delta calls and 20 delta puts. That's the first thing. Second thing, your annualized yield should be akin to the risk you take, and you're taking equity-like risk. So north of 12%, but it's also stock dependent. If it's a very volatile stock, like NVIDIA, it's got to be more. And it is more. Right now it's 45% annualized. So something else to think about. Look at the price of options in a historical context. So go back 1 year, go back 2 years, however long you want to go back. But bear in mind that if you go back through something like the pandemic, you're going to be including some idiosyncratic events that probably aren't as applicable now. So I don't necessarily advocate that, but it's good to do that anyway, just so you have a sense of, what's the worst case. Pandemic plunge was kind of a worst case. The GFC was kind of a worst case. So stress testing your ideas, doing something like that is also advisable. Options to sell. Which ones do you sell? Going out a year is not a good idea. I don't like selling really long dated options. The decay isn't that great. And also the term structure, that slope that we were talking about, it steepens as you start getting around that 100 days and in, 90 days and in. Then it starts to fall off. So you're getting both decay and you are getting the possibility of a vol crush. So that's a positive. Adjusting your strategies. When you are short options, manage your risk aggressively if you can. So when an option, if you sell a 20 delta option and now it's 60, it's time to do something. Because now an option you were short, an option you sold thinking it was going to expire out of the money, has now become an option that is more likely than not to expire in the money. So consider adjusting it. Another important thing. Some people advocate riding a short option all the way to expiration. I do not. A couple of reasons for this. Is it true that most nickel options expire worthless? Mm-hmm. But you're picking up nickels in front of a train. It's like they're littered along the rails of the track, and you know there's a train coming. Someday it's going to get there, and you're sitting there collecting those little nickels. The risk isn't worth it. Don't play in that space. Some people do, and it's fine, but I wouldn't suggest it. And certainly don't do it as you're just getting started, because you're going to make tiny amounts of money, and then if something disastrous happens, it will indeed be exactly that. It's going to be a huge blow up. So be careful with that. And watch out for catalysts, vol percentiles. Have I forgotten anything else here? Probably. But if that stimulates any questions, put them in the chat, or come back and watch us on Wednesday when we're going to do another one of these, and bring it up then, and I'll be happy to try to answer it, because I certainly don't remember everything every time. But I appreciate you guys sticking around for this one. And we will probably talk about some upcoming earnings catalysts and maybe some other short premium strategies because vol is higher. Until then, thanks for watching.